Miguel.
Yes, sir.
Welcome back, sir.
Thank you. It's good to be back. Yet another exciting week of calamity in the economy.
Welcome to the United States in 2023.
Yeah. The world we live in.
What's
yeah.
your analogy to get us started today?
Well, there's a lot of different ones. Okay. My granddaughter and I, we like to have a staring contest, right? And for those who don't know, I'm blind. And so how we play is I'll stare at her for a while, and then I just wait a certain length of time, and then I go, oh, I heard you blink.
Oh, man.
And she believes it. Well, she did until somebody in my family told her it's not true. And so anyway, I'll probably get talked to for even having this discussion. So, I used to beat my granddaughter at the staring contest. Well, old Jerome Powell is having a staring contest with inflation, and inflation doesn't blink. All it does is put on more expensive sunglasses.
Oh, man. Well, this is real estate and the economy this week with me, Jared Uraine, and the armchair economist himself, Miguel Francis. To get us started, my friend, we do have a short market update in real estate. And as I mentioned earlier, our median home price was at $430. Still, we have some new numbers that are coming out because we have seen multiple offers on homes in every price point, including over $600,000. And what that means is our inventory still is under 2 months, but it's not enough to be able to satisfy the current buyer demand. While we had rates last week up over 7, today it's at 6.95 for a 30-year fixed and a 6.40 on a 15-year fixed.
Wow.
We expect them to kind of stay in this arena for the moment. We do know that the recent news headlines have been talking about the Fed raising the rate in June.
Right.
And we've been talking about it for the last couple of months, fully expect it to happen, despite what everybody else was saying. And even the perspective of other Wall Street investors have shifted towards more in alignment with what we've been talking about in the sense of it's going to take a little bit longer than everybody wanted.
It'd been better if I was wrong.
You're correct. I mean, you're wrong.
Yeah, it's always best when I'm wrong.
It's always best when you're wrong, my friend.
Unfortunately,
yes.
I wasn't. Yeah, it's too bad. Yeah,
and
we'll try to be wrong this week.
Well, let's see how hard we can put that effort. The nice thing is that at the moment, this window of opportunity allows sellers who are seriously thinking about making that move at this moment, making this a very good opportunity for folks to be able to put it on the market, get the best price that they can for their house. Now, of course, it's going to matter, of course, the condition, as well as what your next chapter is, and all of that requires a consultation to help you really nail down what your needs and wants are. As far as buyers go, competing in a competitive marketplace is challenging, but it's not impossible. Making sure that you work with an expert who is able to not only get you what you're looking for, but also get terms that are favorable to you in the purchase. And in today's market, we're going to see that continue on for the next couple of months until we can get more inventory. Fully expect probably later this year to see things kind of go back to some sort of normal in terms of our inventory from there. But in the meantime, summer is the hottest time of the year for us to be able to get things going, and we're taking advantage of every opportunity we can. As far as the economy goes, Michael.
Well, to sort of dovetail what you were saying, you were talking about the real estate and mortgage rates, et cetera. Mortgage rates are strongly tied to treasuries. And treasuries are up at the moment. And we're concluding the debt ceiling saga.
Oh, yes.
Hopefully, we've been talking about it. It's time to move on to a different topic. But the dilemma is, if everything works correctly, we may only be facing a downgrade of the credit worthiness of the United States because they came way too close to the X date. The X date now, according to Janet Yellen, is a Monday. They vote tomorrow in the House, then it's got to go to the Senate and then get signed off by the executive branch. That's way too close to the X date. So if the full faith and credit of the United States gets downgraded, then we're going to pay higher mortgage rates because treasuries are going to be higher. We'll pay higher on our car loans, personal loans, credit cards. All of us will pay higher. And even if you don't have any debt, you're still going to pay higher because the
Everything
vendors
else.
you do business
Yep.
with take loans to run their businesses.
Yeah.
Those interest rates for those businesses are going to be, that money is going to be more costly for those businesses. For them to continue to sustain themselves, to stay alive as a business, they're going to have to increase.
They're going to package in those pricing
You
adjustments.
bet.
Yeah.
And now we're on to inflation.
Yeah. Back
Yeah.
to inflation.
Back
Keeping
to
it going. I
inflation.
mean,
Yeah,
that's what
yeah.
we've seen over the last year and a half.
Right,
Prices
right.
go up, and I mean, just the whole conversation about eggs and how they took advantage of that pricing point
Right.
to be able to wrap in some of their profits.
Right.
But back to the debt ceiling conversation, with that being theoretically resolved,
Right.
in terms of
If everything works out perfect, right?
yeah, theoretically.
Yeah.
in terms of that being able to be, oh, sorry,
Resolved.
Dilsey is making an adjustment on your microphone.
Oh,
Is it fully answered, the question of being able to adjust it, or is this some sort of kick the can down a road scenario?
the debt ceiling?
Yes.
No, they have raised the debt ceiling for 2 years, and they made some concessions on both sides. I kind of makes me think of a wonderful guy by the name of Sam Shaka. He was the top a real estate agent in Visalia, California, many years ago. Old Sam in a very small town used to do about 85 transactions a year. The guy was a walking office all by himself. And Sam used to say the best real estate transactions were when nobody was happy. Everybody thought they gave too much. And so as far as the negotiation of the debt ceiling, that might be perfect because it seems like nobody's going to be happy. So if they can just make that happen, preferably before we get within 72 hours of the X date. Because if we get within 72 hours of the X date, you can almost be sure that the credit of the United States will be downgraded. So we'll see how quickly they can do it.
So in 2009, 2010, the debt ceiling was less than the national GDP.
Right.
And somewhere amongst those years, around 2010, the actual ceiling surpassed the GDP.
Right.
And we are now at 129% of GDP.
Right. But to put that in context, the United States is the the dollar is the reserve currency for the planet. China's debt is about 280% of its GDP. Now, many economists think that's not sustainable, and I agree. I don't believe it is. And we believe that the Chinese economy is going to slow down. They should hit their target of 5%, GDP this year, but that's far slower than where they've been, over the last decade or so. But but it's okay that the United States debt is in excess of its GDP because the United States has 24 trillion, with a T, dollars worth of treasuries out there that people hold, that other countries hold. And there's no second place. The closest country that comes second to the United States would be Germany, and Germany's just in the neighborhood of 2.5 trillion. So if you're looking to purchase treasuries as a secured currency, and I mentioned Germany because they have a AAA rating. If you're looking to purchase a secured treasury note or security or bond, there's the United States, then there's nobody. So the fact that they're what did you say, 129% of their GDP is not going to hurt the value of the dollar or even hurt the economy of the United States because, as I mentioned earlier, the dollar is the world's reserve currency. 50% of the planet backs their own currency with U.S. treasuries in the U.S. dollar.
Right.
Yeah.
The part that does have an impact on potentially the value of the dollar is this dance with the debt ceiling, because potentially it creates consequences that we all will end up having to pay for: higher interest rates, international credibility, eroding that.
A little
and then
bit, yeah.
Being able to put some turmoil into the financial sector.
Yeah, a little bit, yeah.
Just a little bit.
Yeah, yeah. But compared to other currencies, it actually rallied in the last few days. When was it? Like Friday, it rallied a little bit. It came to a 2-month high, the dollar, against other currencies, and against the Japanese yen, and so the dollar is strong. There's no dethroning it, at least not in my lifetime, as the world's, so it's going to continue. It's just, is it going to continue in such a way that makes life not as complicated for the rest of us as it does, you know? So the Federal Reserve, they're in a tough spot. PCE, personal consumption expense, came in on core rate inflation on Friday at I think it was 4.6. It's actually going up. The PCE is going up, the core rate. It's sort of forcing the Federal Reserve into a no-win situation. They're going to have to, again in July, raise the rates another quarter point. I think last time we talked, the market said there was a 20% chance the Fed would raise the rate. I said 40 last week. Well, now the market says 65% chance that they're going to raise the rate when they saw the PCE numbers come in on Friday. Well, what's going to happen this week, starting tomorrow, you're going to have, on Friday you will have unemployment numbers, and tomorrow we'll have applications for people applying for unemployment. And those numbers, I think Friday is going to be disappointing to the market. The market's expecting 3.5. I wouldn't be surprised if it held steady at 3.4. That's just more stress for the Federal Reserve to continue to hike that interest rate. So then that brings us to the question, where's the next calamity? Where's the next economic storm going to happen?
Right.
Yeah.
So if the banking sector survives, do you have any indicators, any ideas?
The banking sector is surviving so far, and that's been a confusing topic for economists, because while they're tightening credit by buying back by selling the bonds back into the market, and while they're tightening credit by raising interest rates, when they had the regional banking crisis, hundreds of billions of dollars went out to support the regional banks, right? So that's like quantitative easing and quantitative tightening at the same time. So that was a little bit confusing. But the one that we've been talking about, that Jamie Dimon talked about, is the commercial real estate market. It's the vacancy rates are too high. Interesting thing about the commercial real estate market, the A-paper loans in the commercial real estate market, those loans were issued at 70 and 80% LTV, loan to value, right? Okay. But because of the vacancy rates in the commercial property, they're no longer worth what they once were. So if you got a loan on a building, and let's say it was 80% loan to value, right? Well, because of the vacancy rate, instead of being what it was once valued at, it's now valued at below what is owed against it. There's a lot of commercial properties out there that are
underwater.
They're underwater, exactly. And so that looks like, to me, the largest systemic stress that's going to happen nationally is the commercial real estate market.
So the differences between the current quote-unquote recession that we're probably in now and the Great Recession of 2008, one of the major issues is not residential, it's currently commercial.
Okay.
Yeah?
Well, okay, sort of yes, but we're not in a recession unless you're in the real estate business.
Very good. Clear it up for me.
Yeah. If you're a realtor, we're in a recession. If you're part of the rest of the economy, we're not. Well, real estate and possibly the technology sector, right? But those are the two sectors that are suffering right now.
We're going through a recession, not recession type deal.
Well, they call it a rolling recession, where it's going sector by sector, But technically, we're not in a recession. They keep saying there's going to be a recession in the next quarter or two, and they keep kicking it down the road. It's hard to be in a recession when employment is as strong as it is.
Right.
You know, the prime age, which is an interesting term. The prime age are people that are between the ages of 25 and 54. That's the prime working age. Which, by the way, you're at
48.
you're at the end. You're
tail
coming
end of that.
Yeah,
Come
exactly.
on.
You're on your way out. So, but the prime working age, 80.08% of those people are working, which is the highest number since the early 2000s. So people are working. It's hard to be in a recession when you have that many people working.
right.
Interestingly, 46% of people Lex's age, our camera guy, Gen Z, 46% of them have a second job on top of their regular job. People your age, right? Millennials. Well, you're not quite. You're too old
Gen
to be a
X.
millennial. Yeah, sorry. Yeah, but millennials, 37% of them have a second job on top of their regular job. That's an increase for Gen Z by 3%, and that's an increase for millennials by 4%. Everybody's working hard to be in a recession when everybody's got a job. Yeah, yeah. So, all of that is what's putting stress on the Federal Reserve to hike the rate. And so, what's going to break next?
Right.
And so commercial real estate looks like a likely candidate because that's a problem on a wider basis than the regional, market, regional banking market. But if commercial real estate starts to tumble, it's going to put a lot of stress on regional banks, and then it'll spread to different sectors, And so that's my biggest concern. But there's one more thing, and that is what's out there that we don't know about.
The unknown.
And if we haven't learned anything in the last few years, the unknown seems to be something that happens on a very regular basis. Nobody knew that COVID-19 was going to happen, right? Nobody knew that there was going to be a war in Europe that would disrupt energy around the planet or disrupt food around the planet. Nobody knew about the incredible inflation that would be going on. Nobody knew about a lot of things that have happened over the last few years. So with all of this stress, with higher interest rates, what's going to break next?
Yeah.
We don't know.
The wave effect of all of these things have yet to be fleshed out, and so it may show itself in the next few months.
Right, because the economy is intertwined. It's connected.
Yeah.
Everything we do affects somebody else.
Yeah.
Yeah. Whether we understand it or not, it does. If you decide to spend $470 at the grocery store, that affects your neighbor whether you know it or not.
Yeah.
It impacts all of us.
Michael, you've always got the insights, man. Anything else before we wrap it up?
Yeah, just keep your eyes on Friday for the unemployment numbers, and also unemployment apps for tomorrow. The unemployment apps for tomorrow, they could be misleading because there are some states back east where there's a lot of unemployment fraud, and so those numbers come in high, but then we get more accurate numbers on Friday. So if those numbers are tight at 3.5% or 3.4% on Friday, then you can be certain that the Federal Reserve is going to raise the rate. I believe the Fed's going to raise. I give it a 80% chance.
80%.
The market says 65. I say 80.
All right.
Hopefully I'm wrong.
Hopefully you're wrong.
Yeah.
Always a pleasure to have you on board, my friend.
Right on.
And thank you so much for your insights.
Thank you.
Look forward to seeing you. Well, we're going to be talking about what happens next week, but yeah, man, we'll keep it going. That does it for this portion of real estate and the economy this week. My name is Jared Uraine with the Uraine Ordonez 5 Diamond Group here at Vice Realty, and the armchair economist, Miguel Francis. Thanks again for joining me, man.
You bet.
Make it a wonderful week.
We're clear.